Want to welcome everybody back to episode 5. So we're halfway to our goal of 10 that we stated in episode 1 or 2, or should I say season 1, episode 5 of the Closing Time podcast with Travis Blayton
and Brian Prawl.
And we wanted to discuss today local versus non-local mortgage lending and what that means. So Brian, I'll kind of let you segue into what we mean by the topic, and then we'll get into the nuts and bolts of it.
Yep. And this is a big thing with a lot of our real estate agents. Like most of the agents that we work with prefer, if they're listing a house, prefer receiving a pre-approval letter on an offer that's being submitted from somebody who they know. One of my agents, Lisa, talks about chokeability factor. If I screw up, she can come over here and choke me. Right. Yep. So there's an element to being local to the market that is really important for that reason. But I think what this term kind of gets conflated a little bit, and what we really mean is professional loan officers versus big box, I'm in a call center loan officer that don't have any skin in the game.
Yep.
And so for us, man, we're local to our markets, which I think is great because we've got some specific examples we will talk about what we know about our markets versus somebody in Detroit, Michigan would know about our market. That helps our pre-approvals and our loans go smoother and be more solid. But in general, what we're meaning is you want somebody who does this for a career, who's highly skilled, fairly compensated, and knows what they're doing, because that's what you need in order to make a mortgage transaction go smoothly. And when mortgage transactions go smoothly, the real estate agent is more likely to get referrals from that client.
Yep.
And so I guess a real example of that is like we're here. I have a vested interest in my community. So if we're in our market, like, you know that I care. If I do mess something up, like I've said this to clients before, you can come pick it on my office doorstep and tell everybody that I'm terrible at my job. That adds a layer of pressure to us to make sure that we're doing a good job.
Yeah.
Now, a lot of people, I'm not saying other loan officers are bad, but they just don't have that risk factor of ruining their reputation with their biggest referral base if they're in a non-local market.
Yeah, and they don't live in the community most times that they serve. And so I've got to see you at the grocery store. I've got to see you at the ball field. And that adds a layer, like you said, of pressure to make sure that it's quick, seamless, and exceeds expectation.
Well, you and I are very similar. We look at each mortgage loan that we do as a family accomplishing their goal.
Yep.
Most other people, the big box call center type people, view that as numbers on a page. Right. And so
that's correct.
There's a different level of service that you're going to provide as a result of me feeling that way about you. There's a different level of, I guess, just care that we provide as a result of, like, I don't want to be embarrassed when I see you and your family at the grocery store or the ball field. I want to be proud to be able to shake your hand and say, how's everything going at the house? Which is something that happens to us on a weekly basis, probably. I mean, we see our clients. The other thing is mortgage loans are very complicated. And it's oftentimes that clients feel better about the numbers, understand the process, understand what goals we're trying to accomplish and why we're asking for certain things, because we've been able to meet them face to face. They're able to look us in the eyes. They're able to shake our hands. They're able to sit down at our desks and we can turn our screen and like go through everything. Because a lot of times, look, you're a high net worth client buying their 10th house. You don't care.
Right.
You're a first time home buyer whose wife is pregnant with your first child and you're trying to build a life for yourself. It matters.
It does.
And you as a real estate agent or you as a client want to work with somebody who cares about that very much, which we do.
And being able to meet with our clients face to face, they immediately like us and trust us more. And having that trust in our team 100% of the time increases the likelihood, I would say, of the process going smoother. Because oftentimes when you're on the phone talking to someone, you know, sidebar from that, you try to reach out to a big box lender on a Saturday morning. Good luck. You'll talk to them at some point Monday or Tuesday. Um, but when you're talking to someone on the phone, especially first time home buyers, they're nervous to tell you that they don't know. And the body language, facial expressions that you can read, I think we're both very good at that when they're sitting across from us, or even if it's on a Zoom call. We can see each other. I can tell the numbers that I just went through, or how escrows are set up, or what have you, they don't understand. Or that they have a question that they don't want me to think that they're dumb for asking.
Yeah, they're embarrassed about asking the questions
Right.
because they don't know what they shouldn't know. And you're to your point, being like, I think the stat is 70% of human communication is nonverbal.
Yep.
And so if you're in Detroit or somewhere in California and you're working with somebody buying a home in South Carolina, you're missing out on 70% of the communication that that person has.
Right.
And so for us, we're able to overcome that. And what it does is a couple of things. One, it helps the client feel more comfortable and understand the very complicated mortgage process.
Mm-hmm.
But in addition to that, it is going to make them feel better about the service that we're providing.
Yeah.
And then is going to lead towards more referrals from or for the real estate agent that referred it to us. All right. So being non-local isn't the end of the world. If you are working with a professional loan officer who cares about his business, it is likely that you're going to be able to close the transaction in another state or in another market. And that's not saying that they're bad people.
Right. We can provide the local feel and the local love and not be in a physical location. You know, I know that you do this as well. I require every client that is under contract to buy a home, they have to meet with me face to face. Like, it's a hard stop. If you if you're if you're unwilling to at least have a Zoom call with your camera on and my camera on so we can see each other, we can't do business together.
Yeah, you're way more hardcore about that than me. I think that's great. I need to have a higher percentage of that done, but I offer it to every single client. I don't require it. I probably should. That's actually something
You 100% should. I was talking to somebody about that this morning. The the movement that or the mindset shift that I've seen from the further that we get away from the COVID years, clients are starting to come back to, I want to meet face to face. Um, you know, the increase alone this year. I mean, we're middle of November, and the number of face to face meetings I have a week now is, it has to be 5 or 6 times.
but you're
What I
including Zoom as a face to face on that.
Yeah.
Yeah, which is fair.
Yeah, absolutely.
What I've noticed is over the trend over the last several years and the thought process from several years ago was all these whatever Gen Z people, they're all used to technology and they want to communicate via technology. Heck, the biggest mortgage lender in the world's entire platform was built off of that online application, online this, AI this. You know, it's and so there's some truth to it. But what I notice is the same generation of people that we thought wanted only interaction via text message or online are also the same generation of people that grew up with helicopter parents
I
and have less of an ability to make decisions on their own without true guidance. And that's a great problem for you and I because we're able to provide that guidance. Whereas a lot of non-local big box type of people are not going to either A, take the time, or B, care enough to do so.
Right.
And so we think that people only want text or whatever. And I'm noticing a lot of my communication is via text now, but that's after the relationship has been established.
Established. Yeah.
And when we're able, like, we know that, like, a lot of the younger people for sure just don't know how to make decisions without some sort of advice from somebody. So where the fear was 10 years ago, we're going to be out of jobs because AI bots are going to take over our roles. And that may happen at some point. I don't know. When AI gets good enough to be better than you and I, then I guess we'll find something else to do. But I think we're a couple of decades away from that happening.
Yeah.
What we're seeing is that the advice we're able to provide and are willing to provide is way more important than we expected it to be a decade ago. And so I think that's a good thing, right? I mean, us being here, we're able to meet face to face. We're able to establish the relationships. We're able to communicate, and pick up on the nonverbal cues that they're letting on. And so it puts us in a position that we're able to provide that higher level of service to the clients, but also to the real estate agent by helping them grow their business as a result of getting more referrals because of our process.
Yeah. And you saying all that just triggered a thought in my head as well that kind of differentiates as well. It is, we heard a stat recently that 1 in 4 loans now are in the non QM space. And so for a listener who doesn't know the difference, you have very standard loan types, which are called qualified mortgages, which are your VA, FHA conventional loans, the run of the mill, everyday, what most people think of a mortgage loan. And we have moved into a market and an arena where now 1 in 4 loans, I think that was through 3 quarters of 2025, are specialty loans, whether it be 1099 loans, 1 year tax return, bank statement programs, all of that. And then also the buy before you sell product that I think we're one of the only ones that offer that, where we have the ability for you to buy a new home before you sell your current home. If you call we'll call them non-professional mortgage people, they have no idea the nitty gritty of those loans, because it does take a little extra expertise, know-how, foresight, and asking the right questions, preparing the borrower, the buyer's agent, and the listing agent for how it's going to flow to get that done. That was just something that just like,
Oh, I mean, you're right. So a much larger percentage of our business now is portfolio lending, right? So like in-house, like kind of non-QM
yeah,
loans, unique loans that most 90+% of loan officers just have zero experience with,
or are terrified of.
and rightfully so.
Yeah.
So what we're noticing, and this is, I guess, selfishly plugging our own business here, but what we're noticing is because we have those products and have developed the skill set, if you're using as an agent, if you're using a non-local or a big box kind of call center loan officer, you're potentially missing out on 25% of the business that you could be closing.
Mm-hmm.
I call it the Wild West of mortgage lending, but that's not an applicable term really, because what people assume when I say that is that they're unsafe loans. And
Right.
that's just flat out not the case. It's just non-traditional methods of getting people approved. And what it requires is an understanding of the guidelines, the baseline for how to
That's
get
right.
somebody approved, but then also knowing that exceptions exist and how to get them and what to ask for. And so when I say 90% of people and loan officers don't know how to do these, most companies have some version of this product that exists. But what we are known for is our guidelines are the most favorable for consumers. And we have the ability, I think 40% of the loans that we close with some level of an exception.
That's correct.
Right? And so when I say the Wild West, what I mean is it doesn't fit the box, but if we are able to get this exception, they might charge us a little bit of a fee, or they might say you might have to put a little bit more down. So, and from my perspective, they're very safe loans because it's
Yeah.
not like 2007 and 8 where you had 100% financing, no income, no job, or whatever.
Well, I mean, it was stated income. Like you called, can you prove to me breathe in the phone 3 times? Cool. We'll send the wire. Like it's not that.
No, I mean, these are people that need to be well qualified. Like you have to have good credit, you have to
Right.
have a down payment, you have to have these things. So the safety of the loans is there, but it's allowing people that otherwise wouldn't be able to buy houses to buy houses. And the
Yep.
fact that we are skilled in them and local is going to help our agents or any agent listening to this pick up business that they wouldn't otherwise close. And then when you couple that with the fact that they go into our same process and are getting the same service and are getting the same touch points and are made to feel really good about our process, like your business is going to grow.
Yeah. Well, that leads into even with those unique products, they still get from us and other local lenders that professional lenders that we know and we share ideas with and we communicate with, they get a true pre-approval. And I think when the first example that I'm going to give a real life situation is just that. Shows the difference between a pre-approval letter and a pre-qualification letter. So a pre-approval letter is income, assets, credit have been verified with documentation. Pre-qualification is I fill out an online application and I get a letter
My credit's
sent to
good.
me
Okay, you can go.
via email. So first real life example loan that's going on right now, set to close at the end of this month. Borrower called big box. We'll call it Space Mortgage, if you know what I mean. That's why I don't mention a name. They send this guy a letter. He goes under contract. He's moving from upstate New York to South Carolina. Send him a pre-qualification letter. They call it a pre-approval letter. He goes under contract with the builder, pledges a pretty large non-refundable earnest money. And what they don't verify is that the property he is selling is downtown New York City. And they look at the principal and interest payment on the credit report, put that in for the housing debt. You'd qualify with both. What they didn't verify is that he's not escrowed. So he pays his taxes and insurance separately, and his tax bill is over $21,000 a year. Couple that with $6,000 or $7,000 worth of insurance and an HOA because it's in a high rise, he doesn't qualify without selling that property. So he calls us in a panic. Is there anything out there? Because the listing agent is an agent that I work with, knew that if it can be done, if it can be figured out, they'll figure it out. And we used our buy before you sell program, and within 25 days, he will keep his property and buy this
Not
one.
near us.
And that's a very simple situation, but it's a $500,000 house that the agent is going to lose commission on because a lender didn't think to simply ask a basic question: is your loan escrowed?
It's funny that I have a similar example. It's a little bit different, but similarly, and this actually goes back to us being local, right?
Yeah.
So like being in our market. So what a lot of people don't realize is, you could buy the same house as a primary residence in South Carolina, or an investment property, and the tax bill essentially triples if the house is non-owner occupied.
Yep.
Right. So client, this loan isn't real time. It closed earlier this year, but client calls up, big box lender, gets pre-approved. They said pre-approved. They did actually go through the process of verifying some pay stubs and whatnot. Where that loan officer messed up is that they quoted the payment and got them pre-approved based off of the current tax bill. So you can get on the county website, see what the current taxes are. He used that number to assume that's what the taxes would be on when the guy purchased it. But two problems with that. One, South Carolina is a point of sale state.
Yep.
Which means that the taxes will be reassessed based off of the new purchase price.
Yep.
That house happened to be bought pre-COVID, and everybody knows what happened to property values post-COVID, right? So, $200,000 tax assessment now. He's buying the house for $450 or whatever it was. His tax bill is going to double based on that. But in addition to that, he's buying it as a second home, not a primary residence.
6% tax rate.
It's not only so 6% tax rate versus a 4% tax rate, but you also give up the school credits.
Yep.
And so a $2,000 tax bill becomes a $6,000 tax bill, just based off that, plus the additional tax assessment. So he went to a pretty significant, probably $8,000 a year tax bill, which is still lower than your $21,000 in New York City by a significant margin, but a lot higher than what he was qualified based off of. And so we had to completely restructure the deal after he got denied there when they found that out, when they got their tax certification from the attorney. But that's one of the things, like I would have known that
up front.
I would have structured the deal. Now, at the end of the day, the borrower ended up buying the house. So it all was not lost, but it created a panic. It created a lot of stress on the client. He had to restructure the loan and actually pay more money than he was planning on to be able to get into the house. And so at the end of the day, what we're trying to get through is like working with somebody that understands that is going to help you. Like I guess we could verify with other people. I think we have a pretty good reputation of knowing what we're doing, closing loans on time, and making our realtors and our clients' lives better as a result of working with us. The reason for that is because we are professional, we care, and we know what we're doing.
I agree. And that's not to say that we're not prone to mistakes. But the longer we're in the business, they become rare and rare.
Neither one of us are perfect. I happen to remember my last mistake. It was in 2002. I remember the day I made that one mistake 23 years ago. He's not laughing like he should have. I don't think that went over like I wanted it to.
I mean, no, because I was having that moment.
Can we edit that out?
No, we don't need to edit that out. No, because it was I missed the numbers that made it funny, but because it struck a nerve with me, because I remember the first mistake I ever made that cost a borrower the deal. And you remember the borrower's name. I remember the address, loan amount, like I remember everything. Which also goes back to what you were saying originally, that a client, borrower, whatever, is just a number on a page for a call center. Like that loan officer would never remember that. They're just on to the next number.
Yeah, and we're losing sleep.
Yeah. That's why I didn't catch the joke there. It's a flashback that like it's like, oh my gosh, I screwed up once. And you didn't laugh on that. But I think so. Back to the pre-approval versus pre-qualification. That's the building block, right? I think another thing that we have started implementing and been doing it for a while now is, and when our agents, realtors go to make an offer, they call us first. And so tell us a little bit about how that plays out, why that's important, why we do that in our business.
Well, that's this morning. I was working on a referral, somebody moving from Washington State to South Carolina. She's a nurse. It's going to work. She's going to be great. But the numbers are tight on her debt to income ratio with her new job for any, I don't want to bore people with income calculation methods, but because of the way we're going to have to calculate income on her new job, the numbers are tight for her to buy this house. And so my first question to the agent was, where are they buying? What's the address? And the reason for that is because in different counties, taxes are different amounts. And so in Kershaw County, you're going to have lower taxes than you're going to have in Richland County, and different than they are in Lexington County. And so, and we know that, where anybody not from here wouldn't know that. They
Right.
wouldn't even care to ask that question. But my first question is, I want to run the numbers specifically to this property.
Yep.
I will oftentimes even go so far as to get an insurance quote, so we know, because those are two major inputs to what your payment are, and will impact your debt to income ratio and therefore your qualification.
And that we have no control over.
Correct. And so I wanted to make sure. So I found out the house was in Kershaw County as a result of that. And the difference in taxes between Kershaw and Richland can be significant. Like in a situation where a couple $100 a month is relevant, or $100 a month is relevant to the qualification, like we need to know that.
Yep, absolutely.
It also helps with the consumer experience, because I'm giving you specific numbers on every single house. Whereas if I gave you a generic pre-approval based on X amount of property taxes on this amount of property price, like your payment could be $100 or $200 a month difference. And then that puts me in a weird spot because you think I'm bait and switching you.
Yep.
Right. And so we've got to do a good job of explaining that to consumers. But because we're asking to get the address before you make the offer, it allows us to be very specific on the pre-approval, give you a pretty close to exact quote on your payment, and then also reach out to the listing agent.
Yep.
And this is a key for us because selfishly, it helps us meet new realtors. We had a question in the last episode about how we network with new agents.
We should have brought that up.
We should have, actually. Hopefully you're watching again. But one of the ways that I meet new agents is by calling the listing agent. So selfishly, I want to do that for my business to grow. But also, it allows me to establish a relationship with 50% of the agents involved in a transaction. And we sometimes end up being a primary point of communication. And what that does is allow the transaction to flow much smoother. We can let them know that we understand the contingencies. We understand all of the things that they need to think we understand about the process. And so we're able to make the process flow smoother, but it also gives them confidence that we've done our due diligence on our buyer. And then they are going to be more likely to advise their seller to accept our offer versus anybody else's.
Correct. And there are so many times where I've called the listing agent and they're baffled that the lender's reaching out to them. And so it's a big separator, I think. We'll end there because as I was rudely interrupted, we're apparently out of time. We appreciate you joining us for season 1, episode 5 of the Closing Time podcast. If you will do us a massive favor, share this with friends and family. Like us on social media platforms. I think we're on TikTok, Instagram, whatever. Share it. We'd love your support. Subscribe to the podcast. Hopefully we'll be on Apple Podcasts very soon if Levi can get his stuff together.
Should we start asking for people to like and share and subscribe early, like as our intro, instead of at the very end? Because
it just hit me. Yeah,
we're boring people. They're not going to listen.
Nobody's listening at this point. So we need
to start introing that. Hey,
we'll start that with season 1, episode 6.
We're only halfway to our goal of being full-time podcasters at this point, so we still got some learning.
That's right. Well, join us next time.
Looking forward to it.